Imagine you own a lemonade stand. You haven't sold a single cup today. But you have a feeling, a projection, that over the next 10 years, you might sell 1,000 cups. In the world of normal accounting, you have $0. But at Enron, you just booked the profit from those 1,000 cups today. You're a millionaire on paper, even though your cash box is literally empty. This wasn't just a mistake. It was the greatest financial magic trick in history. A $70 billion empire built not on energy, but on an accounting loophole that allowed them to hallucinate profits and vaporize debt. Today, we go inside the room where the smartest guys in the room broke the world. This is how Enron used mark-to-market accounting to pull off the ultimate heist. Before we dive into the math that fooled Wall Street, make sure to hit that subscribe button and turn on notifications. We break down the world's most complex business scandals every week. Houston, Texas, the late 1990s. If you walked into the Enron headquarters, you weren't entering a utility company. You were entering a temple of ego. For 6 consecutive years, Fortune magazine named Enron the world's most innovative company. They weren't just selling gas and electricity anymore. They were trading it like stocks. They were the masters of the universe. And at the center of this universe were 2 men, Kenneth Lay, the visionary, and Jeffrey Skilling, the man with the plan. Skilling had a condition for joining Enron. They had to change how they counted their money. He hated historical cost accounting. In the old world, if you spent $10 million building a power plant, you recorded that cost and waited years for the profits to trickle in. Skilling called this old-fashioned and clunky. He wanted something faster, something sexier. He wanted mark-to-market, MTM. To understand the collapse, you have to understand the magic. Normally, mark-to-market is used for trading securities, stocks or bonds that have a clear daily price on an exchange. If you own a share of Apple and the price goes up, you update your value. Simple. But Enron took this concept and applied it to complex, long-term energy contracts. Contracts that would last 20 years. Here is how the scam worked. Enron would sign a deal to supply gas to a factory for 2 decades. On the day the ink dried, Enron's geniuses would sit at their computers and calculate the present value of all the profit they expected to make until the year 2020. If they estimated $50 million in profit, they would record that $50 million as current income immediately. Think about the danger here. This wasn't actual cash in the bank. It was a guess, an estimate based on future gas prices, future demand, and their own optimistic projections. But what happens if the estimate is wrong? What if the factory closes or gas prices drop? In a sane world, you'd take a loss. At Enron, they just did another projection to cover the gap. Why would a company do this? Because Wall Street is a monster that needs to be fed every 3 months. By using MTM, Enron could make their quarterly earnings look exactly like whatever the analysts wanted to see. If Enron needed an extra $100 million to hit their target, they didn't work harder. They just signed more contracts and used even more aggressive assumptions in their MTM models. It was a treadmill that only went faster. Every year they had to sign even bigger deals just to keep the growth looking consistent. But there was a massive problem growing in the shadows. While their earnings, the paper profit, were skyrocketing, their cash flow, actual money, was bleeding out. They were spending billions on real assets, pipes, plants, and ships. But the income was just digital ink. Enron was a starving man wearing a tuxedo, trying to convince everyone he was at a banquet. By 1999, the gap between their paper profits and their actual debt was becoming a canyon. If the public saw how much debt Enron was actually carrying to fund their lifestyle, the stock price would crater. Enter Andrew Fastow, the CFO. Fastow created a web of thousands of special-purpose entities, SPES, with names like LJM, Chuco, and Raptor. These weren't real companies. They were accounting ghosts. Fastow would sell Enron's underperforming assets or their massive debts to these SPEs. To the outside world, the debt vanished from Enron's balance sheet. But in reality, Enron was just moving money from their left pocket to their right pocket while hiding a hole in the middle. And the collateral for all these secret deals? Enron's own stock. As long as Enron's stock price stayed high, the ghosts stayed in the closet. But if the stock ever dropped, the entire house of cards would come screaming down. And that's exactly when a journalist named Bethany McLean started asking a very simple question that no one could answer. How exactly does Enron make its money? By the year 2000, Enron was at its absolute peak. The stock was at $90.56. They were the darlings of Wall Street. But underneath the shiny surface, the mark-to-market engine was starting to smoke. You see, the problem with booking 20 years of profit today is that you eventually run out of future to borrow from. To keep the stock price rising, Enron needed a new miracle. They thought they found it in Enron Broadband Services. They announced a deal with Blockbuster to stream movies on demand. This was years before Netflix was even a thought. Even though the technology didn't work and the deal collapsed within months, Enron used MTM magic to book $110 million in profits from a partnership that literally produced zero revenue. Imagine that. Reporting $100 million in profit for a failed project that never sold a single ticket. This was no longer accounting. It was pure fiction. But then, the dot-com bubble burst. Energy prices began to fluctuate. And for the first time, the smartest guys in the room started to look nervous. In March 2001, a journalist named Bethany McLean published an article in Fortune magazine titled, "Is Enron overpriced?" She noticed something nobody else wanted to see. Enron's financial statements were indecipherable. Even the smartest analysts couldn't explain how Enron actually made its cash. When she interviewed Jeffrey Skilling, he called her unethical for even asking the question. But the seed of doubt was planted. Short sellers, the vultures of Wall Street, began to circle. They realized that Enron's high stock price was the only thing keeping Andrew Fastow's ghost companies from exploding. If the stock dropped, Enron would be forced to pay back billions in debt that they had hidden off the books. It was a ticking time bomb. Then, the unthinkable happened. In August 2001, just months after becoming CEO, Jeffrey Skilling suddenly resigned. He cited personal reasons, but the market knew better. It was like the captain of the Titanic jumping into the only lifeboat while the band was still playing. Inside the building, panic set in. Sharon Watkins, a vice president, discovered the truth about Fastow's secret partnerships. She wrote a now legendary memo to Kenneth Lay, warning him, "I am incredibly nervous that we will implode in a wave of accounting scandals." She was right. The wave was already crashing. October 16th, 2001. Enron reported its first quarterly loss in years. But more importantly, they revealed they were restating their earnings, admitting that $1.2 billion in shareholder value had simply vanished. The SEC opened an investigation. The stock price didn't just drop. It went into a terminal freefall. $80, $50, $20, $5. As the stock plummeted, those special purpose entities Fasto created were triggered. Suddenly, Enron owed billions of dollars that they didn't have. The mark-to-market gains they had recorded years ago turned out to be worthless paper. In a desperate move, Enron tried to sell itself to its smaller rival Carnegie. But when Carnegie looked at Enron's books, they ran away in horror. Enron was radioactive. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. At the time, it was the largest bankruptcy in American history. This isn't just a story about numbers. It's a story about people. When Enron collapsed, 20,000 employees lost their jobs. But it was worse than that. Enron had encouraged its workers to put their entire life savings and 401k retirement plans into Enron stock. While Skilling and Lay had sold millions of dollars in stock before the crash, the average employee was locked out of selling. They watched their retirement funds go from $500,000 to $500 in a matter of weeks. And then there was Arthur Andersen, one of the big 5 accounting firms in the world. When the investigation started, Andersen employees began frantically shredding tons of Enron documents. The scandal was so massive that it didn't just kill Enron, it killed Arthur Andersen too. An 89-year-old firm with 85,000 employees vanished because they helped hide the lie. Kenneth Lay was convicted, but died before he could go to prison. Jeffrey Skilling served 12 years. Andrew Fasto became the star witness against his former bosses. But the real legacy of Enron is the Sarbanes-Oxley Act, a law passed to ensure that CEOs can never again say, "I didn't know what was in the books." Today, they have to sign them personally under penalty of prison. Enron taught the world that you can't use math to outrun reality. You can mark your dreams to market all you want, but eventually, the bill always comes due. The smartest guys in the room forgot one thing. In the end, the market doesn't care about your projections. It only cares about the truth. The Enron scandal changed finance forever. But are we seeing the same patterns today in the world of crypto or big tech? Let me know your thoughts in the comments below. If you found this breakdown valuable, share it with someone who loves business history. And don't forget to like and subscribe for more deep dives into the world's biggest corporate collapses.